Hi, I'm Claire Gunnell from Palmers Accounting, and welcome to our taster session for our Profit Accelerator program. At Palmers, we're growth-focused accountants that help ambitious business owners that want a better understanding of their financial data insights so they can make brilliant business decisions. We also love upskilling business owners to demystify the financial jargon, and that's why we've introduced our Profit Academy. Our Profit Accelerator program is a webinar series delivered over 6 weeks, 1 hour per week, to help business owners uncover how they can significantly improve the profit in their business and drive business growth. Those of you who've read Lewis Carroll's book, Alice in Wonderland, will recognise this extract from the conversation between Alice and the Cheshire Cat. "Would you tell me, please, which way ought I go from here?" asked Alice. "That depends a good deal on where you want to get to," replied the cat. "I don't much care where," said Alice. "Then it doesn't matter which way you go," replied the cat. "Well, what's this got to do with you and your business?" Well, if you genuinely don't care what happens to you and your business in the future, this approach might be okay. But for everyone else, with loved ones depending on them, with employees and their families, customers and suppliers, all of whom would be negatively impacted if your business fails, you really do need to know where you want to be in the future, and you need to be clear on when you want to get there. When Sir David Brailsford took over the British cycling team in 2002, they'd only had won 1 gold medal in their 67-year history. In 2008, at the Beijing Olympics, the British team won 7 out of the 10 gold medals, and they repeated that success in London 4 years later. Plus, the team then went on to win 3 out of the next 4 Tour de France events. So how did they achieve this extraordinary success? Well, they did it by breaking down everything that goes into competitive cycling and finding ways to make small 1% incremental gains to achieve an aggregated increase in overall performance. Some people are perfectly happy and like things just the way they are. Some would like a little bit more success so they can spend more time doing what they want to rather than having to go into work every day. And some people want to build the next Amazon. And whilst we may all want different things, what's common is that we all need a plan, and we need to understand the key drivers for success. And above all, we need to measure what matters. The vast majority of businesses rely on lag measures, a situation which isn't helped by most accountants who typically focus and report on outputs. So let me give you some examples of outputs. They would include what you've sold, how much profit you've made, how much cash is in the bank. And this is typically delivered as a set of year-end statutory accounts that are not produced until 6 to 9 months after the year end. All of these are outputs, and they focus on what for most of us is by now ancient history, and they're ineffective for management control. So let's discuss the input drivers, the critical business growth drivers that you need to understand, measure, and review on a regular basis. There are some things that apply to all our businesses. The terms may change slightly, but the fundamentals are by and large the same. And if you're here, I assume that you're keen to grow your business. So where should you focus most of your attention? Should you focus your efforts on new customer acquisition? What impact would improving your customer retention have? Should you strive to increase profit margins? Can you persuade customers to increase their purchase frequency? Should you work to increase average transaction values? Should you concentrate on cutting overheads and improving operational efficiency? Or should you focus on all of them and work to make small incremental improvements over time? Let me introduce you to Alex and Alex's company, KPI Software. It's a totally fictional company, but with some very real numbers. And here we can see a typical profit and loss account. We can see revenues flat or slightly down year on year. So Alex's business isn't growing, but it's not all bad news. Alex has managed to improve the gross margin by 1%, which has increased the gross profit by nearly £10,000. Also, overheads have reduced compared to last year by exactly 10,000, leading to an increased net profit from what was 60,000 in the previous year of trading up to nearly 80,000 in the most recent year of trading. Alex, in common with many business owners, pays herself the minimum through PAYE to save on tax and NI, and has been advised to draw the majority of her income through dividend payments. So with an extra £20,000 of profit, we can safely assume that Alex is going to be looking forward to a substantial and increased dividend payment this year versus last. But we have a problem. Whilst Alex has changed slightly, the numbers haven't. But what we didn't see before was the cash flow position. And KPI Software has an overdraft of £53,000. So Alex would like to draw a dividend of 40,000, but there's a problem. With a £53,000 overdraft, that's simply not affordable. So what's Alex going to do? Maybe try asking the bank for an additional £40,000 facility so he can pay himself? Well, good luck with that. Clearly, we need a plan to solve the problem. And over the course of our 6-week Profit Accelerator program, we're going to learn exactly that, how we can make small incremental improvements so that Alex can improve both profits and the cash flow position drastically. And to do that, we can only achieve these improvements if we truly know our numbers. And by way of illustration, let's look at one factor and consider the impact of discounting. Here we have a product that sales price is £100. The cost of sales, which is the direct cost of producing the product or service, are £65. So we're left with a gross margin of £35 or 35%. Frequently, the fastest way to increase profit margins is to stop discounting. Conversely, the fastest way to decrease profit margins is to offer discounts. So let's look at this in more detail. And we've got 3 scenarios here. Scenario number 1 is where we're offering no discount. Our sales price is £100. We know our cost of goods is £65, and we're making £35 of profit for each unit we sell at a 35% gross margin. But let's look at the full profit and loss. So assuming we have a turnover of £1 million, and this business has overheads of 28%, or in absolute terms, 280,000. We can then see that the company generates a net profit of £70,000 or 7%. How about scenario 2? So in this scenario, our sales team are offering a 10% discount. This reduces our sales price to £90. The cost of goods is still £65, so we're now making a £25 profit for each unit sold. Our profit hasn't reduced by 10%, but it's now 28% gross margin, down from £35 to £25 per unit sold. And if we look further down into the profit and loss, we can see that our turnover is now 900,000. Our cost of sales is still 650,000. So our gross profit has reduced to 250,000. Our overheads are still 280,000, so we're now making a loss. We've made a £30,000 loss, so minus 3%. Scenario 3 is where we've received client feedback that indicates that we can increase our prices, and we're going to put them up by 10%. So this increases our sales price to £110. Our cost of goods sold is still £65, so we now make a profit of £45 per unit sold. So our profit hasn't increased by 10%, but it's now 41% gross margin, which is up from the increased price of £35 to £45 per unit sold. And our net profit after our overheads has now over doubled. It's now 15%, which is over double the 7% net profit that was the original price positioning. So if you're considering discounting, you need to understand how much more you need in top line sales to make the same profit margin. Equally, if you're looking to improve your gross margin, increasing prices is the fastest way to achieve this. Certainly something that every business owner needs to have a clear understanding of to ensure that they're able to grow their business profitably. And during our webinar series, we'll delve into a wealth of low cost and no cost strategies that will improve our business performance and, most importantly, profits and cash flow. This is the agenda that we're going to cover over the 6 weeks. We'll start by demonstrating how, by tracking and improving just a few key business growth drivers, that we can improve our revenue, profits, and equity value exponentially. Then we'll move on to look at each of the key business growth drivers in turn and share some invaluable strategies that we can implement in our business. We'll identify the opportunities for quick win, cash generation, cost savings, and strategies to improve your operational efficiency, plus strategies you can implement to improve cash flow. Week through 3, we'll move on to gross margin. It's crucial to ensure your gross margin rates are optimized because by far the fastest way to increase your profit is through improving your gross margins. Week 4, we'll share more simple strategies for increasing sales without having to find new customers. Strategies designed to increase your total number of transactions and your transaction value. We'll focus on finding the hidden opportunities that lie within your existing customer base too, through upsell and cross-sell to existing customers. Week 5, we'll focus on customer attrition. Some would argue that this is the most important business growth driver, and it's the one that many businesses completely neglect. Maximizing engagement and satisfaction improves customer retention and makes it much easier to cross-sell and upsell. It also increases referrals too, which brings us on to week 6, the last of our growth drivers, but by no means least. We finally move on to look at new customer acquisition. And finally, you'll notice that there's an optional bonus session too, for those of you that are starting to consider what you need to put in place for a successful business exit. It starts by knowing exactly how much wealth you need to accumulate and by when. Whether you plan to exit or not, you should always strive to run your business in a way that makes it exit ready. To do the job without compromise, typically this takes 4 to 5 years of planning and sometimes much longer. So our next webinar series starts on Thursday, the 12th of September, 9 a.m. to 10 a.m. each week. Simply click on the link to register, and we have a discounted rate for our next webinar series of £300. So that's just £50 investment per session. And this comes with an unconditional 100% money back guarantee. If at the end of the 6 weeks, for any reason, you don't believe that you've received outstanding value for money, just say so and we'll refund 100%, every penny, no questions asked. So you really have nothing to lose and everything to gain. Thank you for your attention, and I hope to see you in September.